2008, the world was told a simple story: that the system failed, that no one saw it coming, that it was an accident. That explanation was repeated on television, in newspapers, and by politicians across the world. And most people accepted it, because the truth was harder to face. What happened in 2008 was not a mistake. It was not bad luck. And it was not the result of ordinary people suddenly becoming irresponsible. It was engineered, designed by incentives that rewarded risk without consequence, protected by silence from institutions that benefited the most, and paid for by millions of people who never agreed to participate. Homes disappeared almost overnight. Jobs vanished without warning. Entire retirement savings were erased. Families who had done everything right lost decades of work in a matter of months. And the people responsible did not lose their homes. They did not lose their careers. They did not lose their freedom. They walked away. This is not the story you were taught in school. It is not the version summarized in headlines. This is the story of how the financial system truly broke, and why it was never designed to protect the people who trusted it. To understand why 2008 happened, we need to go back. Long before the collapse, long before the panic, back to the moment when the system quietly changed its priorities. For years leading up to 2008, the American economy looked strong. Home ownership was rising, credit was cheap and widely available. Interest rates were low. Buying a house was no longer just a personal milestone. It became a financial strategy. Homes were treated like assets that could only go up in value. Banks encouraged this belief. Politicians reinforced it. Media repeated it. A house was no longer a place to live. It was an investment, a retirement plan, a source of borrowed money. People refinanced their homes repeatedly, pulling cash out as prices climbed. The system rewarded optimism. Behind the scenes, however, the structure of the financial system was shifting. Banks were no longer focused on long-term stability. They were focused on quarterly growth, and growth required one thing above all else: debt. Traditionally, banks made money in a simple way. They lent money carefully. They collected interest over time. And if a borrower failed, the bank absorbed the loss. That model was slow. So Wall Street changed it. Mortgages were no longer treated as long-term obligations. They became raw material. Banks bundled thousands of home loans together and transformed them into financial products. These products were sold to investors around the world. They were called mortgage-backed securities. Once a loan was sold into one of these bundles, the bank no longer cared what happened to it. Whether the homeowner paid or defaulted no longer mattered. Profit was immediate. Responsibility was gone. This separation between risk and reward changed everything. Banks could now issue loans aggressively, knowing the consequences would fall on someone else. The more loans created, the more products could be sold, and the more profits could be generated. As demand for mortgage-backed securities exploded, Wall Street needed more mortgages. So, lending standards collapsed. Borrowers were approved without income verification, without employment checks, without meaningful credit analysis. Some loans were approved in minutes. These became known as subprime mortgages, loans given to people who were unlikely to repay them over the long term. But repayment no longer mattered. Failure was no longer a risk. It was built into the system. As long as housing prices continued to rise defaults could be hidden. The system was expanding faster than anyone could control, and no one wanted to slow it down, because slowing down meant fewer profits. To make these risky products appear safe, rating agencies played a critical role. They labeled complex mortgage bundles as AAA, the highest possible rating, the same rating given to the safest government debt. Investors trusted these ratings. Pension funds bought them. Insurance companies bought them. Governments bought them. Trillions of dollars flowed into products that few truly understood. Very few people questioned what was inside, because questioning the system meant challenging profit. And profit was the only thing that mattered. As long as housing prices kept rising, the illusion held. But systems built on illusion do not collapse slowly. They break all at once. Behind the scenes, the system was far more fragile than it appeared. Banks were not just investing money. They were borrowing enormous amounts of it. This practice is called leverage. For every dollar a bank actually had, it was lending and betting dozens more. In some cases, leverage ratios reached absurd levels. A small loss could wipe out an entire institution. But leverage was encouraged. Why? Because it amplified profits during good times. Executives were rewarded with massive bonuses based on short-term gains. Losses, if they came later, would be someone else's problem. Risk was privatized during success. Failure would be socialized. The system was designed to grow fast, not to survive stress. And stress was coming. In 2006, housing prices stopped rising. At first, almost no one noticed. Then, defaults began to increase. Subprime borrowers were the first to fall behind. Adjustable rate mortgages reset to higher payments. Monthly costs exploded. Homeowners could no longer refinance. They could no longer sell. The illusion began to crack. As defaults increased, mortgage-backed securities lost value. No one knew how bad the losses were, or where they were hidden. Banks stopped trusting each other. Credit froze. The system that depended on constant movement suddenly stopped breathing. In September 2008, the collapse became undeniable. Lehman Brothers failed. One of the oldest and most powerful investment banks in the world was gone. Overnight. The message was clear. No institution was safe. Markets panicked. Stock values collapsed. Retirement accounts evaporated. Businesses lost access to credit. The global financial system stood on the edge of total failure, and ordinary people paid the price immediately. Government stepped in, not to save homeowners, not to protect workers, but to rescue the financial institutions that caused the collapse. Trillions of dollars were injected into banks deemed too big to fail. Executives kept their bonuses. Banks survived. The system remained intact. Meanwhile, millions lost their homes. Foreclosures swept across entire neighborhoods. Unemployment soared. Lives were permanently altered. The message was unmistakable. If you are powerful enough, failure is forgiven. If you are ordinary, failure is final. Very few people were held responsible. No major executives went to prison. No meaningful reforms dismantled the structure that caused the crisis. Instead, the system was patched, not replaced. The same incentives remained. The same risks were preserved. The same cycle was allowed to continue. The lesson learned by Wall Street was not caution. It was confirmation. 2008 was not an accident. It was the logical outcome of a system built on greed, leverage, and silence. A system where profit mattered more than people, where warnings were ignored, where accountability disappeared upward. And the most dangerous part? The system still exists. The mechanisms remain. The incentives are unchanged. The next crisis will not look exactly like 2008, but it will come from the same place. And when it does, the question will not be, how did this happen? The question will be, why did we pretend we didn't know?